HMRC estimate that around 1.8 million people in the UK now earn over £100,000, and if you're one of them, you could be paying an effective tax rate of 60%. I'm an accountant and work with high earners and property investors to improve tax efficiency. In this video, I'll explain how the 100k tax trap works and how strategic pension contributions can be used to reduce the impact. The reason this happens is once your adjusted net income goes above £100,000, you start losing your personal allowance. The personal allowance is the amount you can normally earn tax-free each year, which is currently £12,570. For every £2 you earn over £100,000, you lose £1 of your tax-free personal allowance. That continues until your personal allowance is completely removed. This creates one of the highest effective marginal tax rates in the UK tax system. A lot of high earners and property investors get caught out by this without realising until after the tax year has ended. Adjusted net income is your total taxable income from salary, rental profits, dividends and other income combined. When this figure sits between £100,000 and £125,000 and 140, your effective marginal rate is broadly 60%. This means you can effectively lose around 60 pence in tax for every additional £1 of income you earn. It's therefore highly tax efficient to try and reduce your adjusted net income below £100,000 where possible. Two common ways this can be done are firstly pension contributions and secondly gift aid charitable donations. I'm going to focus on pension contributions in this example. Pension contributions reduce your adjusted net income because gross pension contributions are deducted when calculating your adjusted net income position. This means pension contributions can potentially help restore your personal allowance. It's really important that you can estimate what your adjusted net income is likely to be before the tax year ends. A practical way to do this is to use your March payslip. For most salaried employees, this is normally the final payslip before the tax year ends on the 5th of April. Your payslip is going to show you your taxable salary year to date, and from this you can then add expected rental profits, dividends and any other taxable income. From there then you can estimate your adjusted net income position before the end of the tax year. Once you've estimated your adjusted net income position, you can then identify how much you are over the £100,000 threshold. For example, if your adjusted net income is likely to be £110,000, then you are £10,000 over the threshold. A great strategy for higher earners is to make gross pension contributions for that amount into a private pension before the end of the tax year. Gross pension contributions means the total amount going into the pension, including the basic rate tax relief. So a £10,000 gross pension contribution would normally mean paying £8,000 into the pension, with HMRC adding the remaining £2,000. This can help reduce adjusted net income and potentially restore your personal allowance position. Using a simple example then, Tim receives a pay rise taking his salary to £100,000. He also receives £5,000 rental profit from a property investment. This gives him an adjusted net income of £105,000. One option available to Tim would be making a £5,000 gross pension contribution into a SIP, self-invested personal pension. This would require Tim to pay £4,000 into the pension, with HMRC adding 20% tax relief. This would reduce his adjusted net income back down to £100,000, therefore avoiding the effective 60% marginal tax band. It's an additional bonus because Tim is a higher rate taxpayer. He can also claim an additional tax relief through his tax return. This part is often missed by higher rate taxpayers. To summarise then, the £100,000 tax trap starts once adjusted net income exceeds £100,000. You begin losing your personal allowance above this threshold. This creates an effective marginal rate of broadly 60% between £100,000 and £125,140. Pension contributions can reduce your adjusted net income. Estimating your position before the tax year ends gives you time to plan properly and give you the opportunity to then make strategic pension contributions to bring your adjusted net income below the £100,000 threshold. Hope you found this video useful. If so, you can look at this next one where I talk about strategies you can use if you have £150,000 in a trading business to purchase investment property with. Watch the video now.